Welcome to NACD BoardVision, where leading boardroom advisors, governance professionals, and seasoned directors discuss critical issues related to your responsibilities in the boardroom.
Welcome to NACD's BoardVision. I'm Peter Gleason, Managing Director of the National Association of Corporate Directors. John Berry is with me again today. John's the leader of PwC's Center for Board Governance. Our focus today is on the SEC in general, and then we're going to take a look at the comment letter process and some recent enforcement actions that should be of particular interest to directors. John, thanks for joining us.
Thank you, Peter, for having me.
The SEC has been getting a lot of press coverage lately, John, and it hasn't all been positive. The aggressive rulemaking agenda mandated by the Dodd-Frank Act is pushing forward, and we expect proposed rules related to Compensation Committee independents and Compensation Committee advisors to be released soon. Final rules on the whistleblower program are also scheduled to be here by the end of March. I recently met with members of the SEC staff on the proposed whistleblower rules. While there are still many unresolved issues and a number of concerns, it looks like the SEC is moving forward as directed by Congress, and we should see the final rules soon. The largest concern about the rule is that it would enable a whistleblower to report directly to the SEC without notifying the company, thereby bypassing the company's internal control systems and the anonymous whistleblower systems that were put in place under Sarbanes-Oxley. While I know the SEC has heard the concerns, we'll have to wait and see what's in the final rules. John, what have you been hearing about this?
Well, Peter, I agree the SEC is very busy with its rulemaking activities. In February, Chairman Shapiro testified before the Senate Banking Committee and gave some statistics around the SEC's progress. As you know, the Dodd-Frank Act required the SEC to enact over 100 rules and to conduct numerous studies, issue various reports, and create 5 new offices. Per Chairman Shapiro's testimony in mid-February, the Commission has issued 7 final rules and 25 proposed rules based on the new law. Of course, as you know, we're now busy sharing the details of these new and proposed rules with boardroom executives across the country. Additionally, the SEC has announced that Sean McKessie will lead the new whistleblower office, which will consolidate existing resources to administer the whistleblower provisions called for under the Dodd-Frank Act. But what we are hearing from the SEC is a significant concern over its budget. The SEC has publicly stated that the agency is already operating under budget constraints and will be further impacted if recent budget proposals are enacted. If adopted, Chairman Shapiro has stated that the agency would have to eliminate 600 staff positions and would be unable to implement the various rules mandated by the Dodd-Frank Act. The SEC had initially planned to hire 800 new employees to carry out its Dodd-Frank responsibilities. We are answering questions from boardroom executives now on just what this really means. What we can tell you is the agency has identified on their website a number of activities that are being deferred due to budget uncertainty. These include the creation and staffing of the Office of Investor Advocate and the Office of Credit Ratings, to name a few. The SEC has also had some slippage in the scheduled timeline for proposing and finalizing some of the rules required by Dodd-Frank.
Thanks, John. In addition to the looming budget issues, we've heard a fair amount about the SEC's need for newer and better technology systems. All in all, they've got a difficult charge. I know that the SEC commissioners and the staff are stretching their resources and budget dollars in order to continue to move their agenda forward. I want to switch to another important activity at the SEC now. Companies with a calendar year end have generally filed their 10Ks, and in many cases their proxies with the SEC by this time. And it's traditionally the time that the SEC begins to review their filings. Can you share a little bit about how the review process works, and then some insights into potential focus areas for this year?
Peter, I'd be happy to. First, it's important to note that the SEC does not and cannot review all filings every year. There's a review cycle. The SEC reviews company filings at least once every 3 years, and the depth and scope vary. Last year, the SEC reviewed over 5,000 filings, which is over 40% of all filings. Based on our recent discussions with the SEC, we expect they will be focusing particularly on a few areas this year. One key area of focus will be loss contingencies disclosures. As you know, Peter, companies have to disclose to investors if they believe there could be exposure for a significant loss of some sort, for example, litigation, regulatory action, etc. The rules in this area have not changed. The SEC has merely made it clear that it's an area of significant additional focus. What the SEC wants to avoid is the big surprise where a matter is barely disclosed or is disclosed with no mention of the probable magnitude of the loss, and then all of a sudden an extremely material charge is announced. My opinion is that the SEC will be demanding full compliance with the existing disclosure requirements. I know this filing season a number of banks have had significant discussions with the SEC about the loss contingency issue. Of course, the concern expressed by companies in complying with the rules is that the extensive disclosures could threaten their legal bargaining position if they disclose what they think they may have to pay. Peter, my prediction is that this will be a significant area where the SEC issues numerous comment letters to many companies.
I think you're right, John. Are there other areas of focus that we should be aware of?
Well, Peter, the SEC has been pretty aggressive in reviewing the adequacy of companies' segment disclosure reporting. As you know, companies don't merely report financial results for the whole company, they also report results for company units based on a rule for segment reporting. In particular, the SEC is reviewing filings to determine whether there may need to be more detailed breakdown of those units based on the rules. Overall, boards need to be comfortable with how management presents the segment disclosure in the financials. The key is whether the segment disclosure is consistent with the information used by management to run the business. Due to the subjective nature of this topic, we have seen that it can take sometimes up to 6 months to get the segment reporting issue resolved with the SEC. The SEC, in addition to the two areas mentioned, continue to focus on goodwill and asset impairments. They have a specific focus on whether a company discloses to shareholders an early warning about potential future impairments or write-downs. If you think about it, it's not dissimilar to the contingency discussion in that the SEC wants the companies to give shareholders warnings if there's potentially bad news on the horizon. If the company does receive a letter, directors should ensure that the company provides well thought out and complete responses. As part of that, they should cite the relevant rules or accounting literature supporting their response. Additionally, if a company is unsure about what a particular comment means, they should call the SEC reviewer for clarification. Everyone needs to remember that comment letters are now public information, so it's not in anyone's best interest to have an extensive back and forth debate on the record.
Thanks, John. Very practical advice for our audience on what could be an awkward process of back and forth with the SEC. Now I'd like to take a few minutes to discuss the recent activity by the SEC in the enforcement area. We know the SEC has been very active, and there's been a fair amount in the press over the past few weeks about some of the companies they've engaged with. The SEC restructured their enforcement division to promote greater efficiencies in pursuing allegations and ultimately bringing charges. And, according to Chairman Shapiro's testimony to the Senate Banking Committee, the agency has seen court-ordered disgorgements up 20%, and the amount of penalties tripling over the past year.
That's right, Peter. The Enforcement Division has been very active, and they have brought a number of cases relating to insider trading, market manipulation, and financial reporting violations. And a few cases have been brought against directors.
In one particular recent case, the SEC brought rather serious action against outside directors of a company. Should directors be concerned that there's greater focus by the SEC's Enforcement Division? And can you share some background and your observations on that case?
Sure, Peter, but before I start, I'd like to say that this case does not appear to be an attempt by the SEC to broaden or change the responsibilities of directors. As a matter of fact, a statement by the SEC's Chief of Enforcement, Robert Kazami, indicated the intent of this action was not to second-guess the good faith efforts of directors. In this case, the directors are being charged with turning a blind eye to numerous warning signs. The SEC charged 3 outside directors, who are also audit committee members, for their involvement with an accounting fraud. The SEC alleges that the board members were willfully blind to numerous red flags signaling the accounting fraud, reporting violations, and misappropriations at the companies. Some of the allegations were that first, the independent directors lacked impartiality since they were close friends, neighbors, and had business dealings with the company and the CEO. Second, directors ignored warnings of the controller, who was unfired, and also ignored findings of 2 audit firms, a law firm, and other professionals who informed them of numerous problematic issues and later resigned from serving the company due to a lack of corrective action. And third, directors allowed the CEO to lead an investigation of allegations against himself with no real board oversight. While I don't believe this case and the related allegations are representative of how most boards execute their oversight role, it does demonstrate the current SEC enforcement environment and the willingness to pursue cases against directors when they appear warranted.
I agree. This case and many others the SEC is pursuing highlights the need for directors to continue to discharge their responsibilities effectively with the appropriate care and professional skepticism. The business judgment rule is alive and well in the courts, but I expect that we'll see this heightened level of enforcement activity continue into the foreseeable future. John, I want to thank you again for joining me on NACD's BoardVision. For further information on this topic and others, please see the NACD and PwC websites and the various resources that are available. That wraps up another episode of NACD's BoardVision. On behalf of NACD and PwC, thanks for joining us.